Here, Vaughn has decided to purchase equipment from Central Michigan Industries. Vaughn issues an $500,000 5-year zero interest bearing note to Central Michigan for the new equipment when the prevailing market rate is 8%, and the company is going to pay off the loan in 5 $100,000 installments due at the end of each year over the life of the note. We have to prepare the journal entry at the date of purchase, round to the nearest dollar in all computations. So let's look at that first. The actual purchase of the equipment. Okay, so I'm going to scroll to the answer real quick. Alright, so what I've done is I have put our information here. We have a $500,000 zero interest bearing note, and the market rate is 8%, so our note is 0%. So when the market is higher than the interest rate on the note, then we're going to get it at a discount. So this is a discount. And since we're going to pay it back in $100,000 increments, this is an annuity. So to get the present value factor for an ordinary annuity, you're going to, first of all, look it up on the table. It's 8% for 5 years, and I just looked it up. You probably have it in your book. Let's see where. Okay, so here's the table. 8% for 5 years, so your present value factor is 3.9927. Alright, so what you're going to do is take your annuity amount, which our annuity amount yearly is $100,000. So take that annuity amount, multiply it by your present value factor, and you get $399,271. So make sure you use the annuity amount, not the full amount of the note. Alright, so that is the present value of your annuity, and that's the amount that will go into equipment, because this is technically how much you're going to pay. And then you're going to record the discount, which is the difference in the notes payable minus the present value of the annuity. The difference here is a discount. So this is really, the discount is just a plug number to make your debits and your credits equal. The next part, Part B, prepare the journal entry at the end of the first year to record the payment and the interest, assuming that the company employs the effective interest method. So the effective interest method, you're going to kind of keep a running balance of your carrying value. So here's what I mean. When you recorded the note on the 1st, January 2nd, 2025, here was the balance. Alright? And then at the end of the first year, you're going to make a payment of $100,000. Then you're going to do your 8% interest, and the 8%, you're going to times it by that balance. So if you take 8%, 0.08 times the $399,271, that will give you your interest amount. This is going to be your interest expense. So you're going to record your interest expense. You're going to debit notes payable because you just paid $100,000 on that note. Your discount on your notes payable, the $31,942, is your plug number. And basically what we're doing is this discount is this amount's gonna keep going down to 0, and you're trying to get rid of that discount and get that note up to the amount, the 500,000. So when you do your interest, you're going to subtract your note payment minus your interest, and your reduction of principal is 68,000, because the 100,000 you paid, some of that was interest. And so you're going to reduce the principal amount by 68,000. So you're going to take this amount, subtract it from your balance, and here's your new carrying balance. So this is what you'll pay interest on for the next period. So part C would be the next payment in the next year. So you're going to take your balance here. Well, you're going to pay 100,000 on the note. If you want to go ahead and record that you paid 100,000 on the note, you're going to take 8% of your carrying value, which is the 331,213 times 0.808. That's going to give you your interest expense. So here's your interest expense. You're paying out cash of 100,000, and so your discounts is the plug figure to make the debits and credits balance. Part D, assuming the equipment had a 10-year life and no salvage value, prepare the journal entry necessary to record depreciation for the first year if you're using straight line depreciation. For that step, you're just going to take the amount of equipment that you recorded, the $399,271. It has no salvage value, so you don't have to subtract anything. So take that amount, divide by 10, and that's how much depreciation expense that you would record.